We're also looking at industrial production in India. The IIP has jumped to a 14-month high, and it's come in at 10.3% in the month of August. So there is this sharp surge that we are seeing, primarily led by the increase in manufacturing activity. The manufacturing sector's output has gone up by 9.3% in the month of August. And in the same period, mining production has also grown. It's grown by 12.3%. So let's put the IIP data and the CPI data in perspective and look at what the minutes of the FOMC meeting are also indicating and how this could move various cues in the market right now. And for that, our guests are joining us to understand the impact of all of this. Let's speak to the Group Chairman of Inditrade Capital, market veteran Sudip Bandyopadhyay is with us on India Tonight. Great to have you with us this evening, sir. Mr. Bandyopadhyay, one would imagine the RBI is going to breathe easy now, looking at this CPI print. Food inflation has eased. Does it mean the markets are going to heave a sigh of relief too? Do you see the rate sensitives, especially the banking stocks, moving up from here, going by the inflation numbers and what the RBI governor has said about them?
Absolutely, Vikram. I think this is a number which is better than what the market was expecting. I think the expectation was around 5.5%, and it has come at 5%. So, of course, this is a good news. We know the inflation was predominantly on account of food items, vegetables, fruits prices going up, and that has started coming down. And the expectation is that with the next crop arrival, inflation probably will further come down. The only joker in the pack was the oil prices, but I think the way India has been managing the oil mix, crude mix, with discounted Russian oil coming in, I think that's also under control. And just for the sake of record, I must also mention here that geopolitical turbulence notwithstanding, I think the oil prices have remained in a range, and that does help the inflation in any case. So overall, I think it's a pretty picture as far as inflation is concerned. Obviously, the IIP numbers were expected to be much, much better, and it has come in on lines of that. So again, that's a good news. Overall, I think this is definitely positive for multiple sectors and definitely for BFSI. As far as BFSI is concerned, there is a confluence of positive news. There is an asset quality issue which was plaguing the sector, which has improved significantly. Loan growth, because private capital expenditure and government capital expenditure has gone up. Loan growth has moved up, and the demand for loan is there. Also, the old bad debts and things like that, written off assets, recoveries have started there. So deposit mobilization is at full swing. So overall, the entire BFSI and banks in particular are at a sweet spot. I also must mention here that some of the banks, particularly large cap banks, are looking, properly valued, attractively positioned for the investors to, look at it from long-term point of view.
Well, there will be cues from the Fed as well. We are seeing the minutes of the FOMC meeting while we are seeing our CPI and IIP data come in pretty handy as we head into the festive season. Peter Cardillo is joining us to tell us a little bit more about the American economy and what the minutes of the last FOMC meeting are suggesting. So we're expecting these interest rates to remain at elevated levels. But at this point in time, Peter, do you expect the recession that we were fearing in the US, how certain are we now that we may not be heading into a recession? And how do you see that affecting emerging markets like India?
Yeah, well, I don't think I don't think we can escape recession, although I think it'll be a mild one. If you look at the macro data, it's been quite uneven. Now, of course, there are strong spots, there are strongholds in the economy, namely the labor market. And I suspect that we're going to see a fairly good Q3 earnings, which means corporate earnings are not collapsing. And so if you look around, you'll see other macro data that continue to show weakness, especially the leading indicators that have been down for over a year. and it's traditionally when you have 6 months of the indicators on the negative side, you'll see that we always head for a recession. As far as the inflation data is concerned, we did have some higher top line numbers inflation, but if you look year over year on the core rate of inflation, it was lower, and that suggests that inflation is going in the right direction, and that tells me that we're probably going to see a pause in the November at the November FOMC meeting, and I think the Fed is likely to have done its work because inflation is moving in the right direction. And despite the fact that if you looked at the FOMC meetings, they obviously contradict what I'm saying. The Fed is looking for rates to stay elevated for some quite time.
Right.
But let's not forget that those numbers were published. Those numbers reflect, right?
Yes.
The pre-Israeli
That's
Hamas.
right. So a lot
conflict.
changes because of that. And let me take that across to Mr. Bandyopadhyay as well. How do you see what the Fed is likely to do from this point onwards? The rates over there remain steady right now at 3.7%. But the RBI would take some cues from what's happening in the American economy and how the Fed is moving with its interest rates. How do you see those cues being taken by the RBI, even as it remains sanguine with our own domestic inflation scenario and our industrial production?
Well, Vikram, of course, RBI will take cues from what's happening in US and what US Fed does, because interest rate differential between India and US is a very, very important factor as far as flows into India is concerned, and rupee value vis-a-vis US dollar is concerned. So RBI will, of course, take into consideration. Now, look at the facts on ground. I think what US Fed, of course, they have a meeting on 31st, end of this month, and we will get to hear the Fed chair also talk. But the fact remains that, as my co-panelist was mentioning, their job has been pretty much done by multiple factors, US Feds. I don't think they need to go and hike rates anymore. They will continue to be vigilant, but probably the need for hiking rate in early November meeting is not there, predominantly because of the fact that yields have already moved up. And because yields have already moved up, there is no need for the Fed to push up rates any further. The second point is inflation is remaining steady, and obviously the trajectory going forward probably will be downwards. And under the circumstances, there will be no compulsion on Fed to increase interest rates further in US. And if status quo is maintained, that definitely will help RBI to maintain at least status quo as far as rates in India is concerned, and maybe review it sometime in the calendar year to 24, maybe towards the March or February, March, they would like to review it, subject to US Fed and US markets remaining where they are or improving from there on.
So right now we are seeing those bond yield surges come off the kind of highs that they were on. As far as the Gaza conflict is concerned, Peter, it's going to have a bearing on how equities on Wall Street move from here. What are your expectations with regard to crude oil prices right now and the pressures that this conflict is going to impose on American equities?
Yeah, sure. Well, as far as yields are concerned, I think they're going to hover around here. I don't think they're going to go much lower. Obviously, the focus remains on the macro data and what the Fed does or doesn't do. And of course, the Israeli-Hamas conflict. You addressed oil prices. Oil prices are up today, despite we saw a large buildup in inventories reported by the API last night. And of course, we're waiting for the Department of Energy to release their inventory data. But I think if the conflict doesn't expand any further than what it is now, then I think oil prices are probably going to reflect demand, global demand. And if you look at at the Eurozone, Japan, you'll see that the Eurozone is probably going to experience negative economic growth, while we will continue, at least for this quarter and possibly the next quarter, continue to grow. So I think the demand problem is going to arise. And of course, let's not forget China. So that means that oil prices are probably not going to go much beyond the levels they are now. Obviously, if there's an expansion of the war, then all bets are off and oil prices will go much higher.
But talking about demand, do tell us, Mr. Bandyopadhyay, from your perspective, looking at the way the impact of these global cues are going to play out in our markets, considering our own macro data on inflation and industrial production, do you think we are set for a bumper Diwali if all goes well? And if so, which are the sectors that you see outperforming?
Oh, absolutely. I think if the status quo remains in US at least, and as Peter mentioned, there is no further escalation of the conflict, other major countries getting involved. If that doesn't happen, I think we are in for a bumper Diwali. Predominantly two facts. One is, FIIs and, US investors have been selling equities in Indian market for quite some time, last 1.5, 2 months. That pace of sale has slowed down definitely. And I strongly believe that at some point of time, they will start becoming net buyers in Indian equity. That's one part. But even without that, if you look at what's happening in India, the strength of Indian retail investors, as well as, because of that, maybe not as well, because of that, the strength of Indian domestic institutions have been increasing. If you look at the SIP data, sheer SIP data, I think about 2 billion per month is the incremental SIP which is happening in India. Now, we have that firepower, Indian funds, Indian institutions of incremental 2 billion to invest in the markets. Now, part of it, of course, will be debt, but majority of it is what we believe is equity or, part equity, part debt. Under the circumstances, and that's what pretty much we are getting seen played out in Indian market, that in spite of foreign institutions selling, I think market has been steady in India and market will continue to remain positive. There are a lot of structural things which have happened, which are ensuring that Indian market continues to move up. We believe that fundamental reasons are there for investors to come and pick up shares in Indian market. And to your question as to which sectors will do well if there's a bumper Diwali, we strongly believe that BFSI is one sector which is still offering great opportunities. Right. Companies, banks like HDFC Bank, State Bank of India are definitely, deserves a better valuation, for lack of, a better word, I would say. Right. And investors will look at that. There are a lot of other sectors, particularly, I would say, in infra and construction related, where also there are significant opportunities. And we believe that also will provide good returns to the investors in the forthcoming quarters.
Several opportunities emerging in India, of course, subject to several moving pieces when it comes to geopolitical concerns, but we'll keep watching all of them. Mr. Bandyopadhyay and Peter Cardillo, many thanks for joining us with your perspective on this edition of India Tonight. Appreciate you being with us.
Thank you.